WatchPitch podcasters and YouTube watchers of the WatchPitch channel. I am so glad you're back with us. And if you're just coming for the first time, we are in the thick of a series focus on exits and exit strategies. And the whole idea is to give you, startups and entrepreneurs and business owners, an opportunity to learn more about best practices as you're beginning to think about selling your business. And I'm here with Tim Montgomery, who is a specialist in valuations. And valuations are an integral part of any merger or acquisition, or certainly a business purchase. So I'm super keen on learning, actually, while we're discovering for our listeners, the opportunity to better understand valuation metrics and how people figure this out. Because I would imagine part of this is the numbers, but there's some other factors that are probably harder to evaluate.
Mm-hmm.
So just to get us started, why don't you tell us a little bit about yourself and what you do and what valuations really are about?
So I work with Redwood Valuation, based out of San Francisco. We've got the East Coast office here in Asheville. And most of what we do at Redwood is venture related. So we're doing valuations of startups, venture-backed companies, and then valuations for the venture capital companies for different reasons. A lot of what we do is when startups issue options, they per the IRS, they have to issue those at fair value, and so they hire us to determine what the fair value. So as part of that, we determine what the fair value of the company is and what the fair value of the individual shares are. We also do a good amount of, for instance, pre M&A valuations, valuations where the valuations where the entrepreneur or ownership just wants to know what the value is at a given point. And then we do valuations post-deal as well, purchase price allocations, where they need to, the acquiring company needs to wrap up the assets and liabilities of the target company onto their financial statements. So they need to know what the pieces of the pie are worth.
So when does that conversation start, where they're going to reach out to Redwood and say, we really need to figure out how much this company is worth? Is that because your clients who are asking you for this service are getting ready to invest in that company? Is that the timing of your conversation with them?
It can happen. It kind of depends. A lot of times it's actually whichever one of those transactions we're looking at, the attorneys are involved in drafting documents and coordinating what everything needs to happen, whether it's an investment or acquisition or really just about anything. And so, and oftentimes the entrepreneur doesn't even really know, doesn't even know that they need a valuation. So oftentimes what will happen is the attorney will say, okay, we've done all the things we need to do here. Now you need to get a valuation done. And is that typically on the business owner to get that evaluation, as opposed to, say, the potential investor who's coming in to want to? Yep. Yeah.
So it's on the owner.
Sometimes the investor, we'll get referrals from the investor saying, hey, these guys are going to be calling you or whatnot. But it's always on in terms of the, who's going to pay for it and who we're working with directly. It's the entrepreneur, the founders.
I guess that makes sense, because they're now, you're kind of in their court a little bit, but that's an interesting dilemma potentially if you're getting asked by an investor to. Do valuators ever evaluate one another's valuation? Does that ever get competitive? I wonder.
So a lot of what we do is audited. I see. For instance, and that firm, so audit firms will sometimes have a valuation practice. And so yeah, it'll get reviewed from the standpoint of if somebody's auditing the financial statements, that'll be part of the audit, right?
I see.
So they'll the value that's going into the financial statements or taxes for tax purposes. So yeah, so it usually is not a competitive thing. The audit, it is
really about the math.
Yeah, and about reasonableness, right? You know, they're looking to see, okay, are the numbers that they're coming to reasonable or not unreasonable?
Well, let's roll up our sleeves for a moment and just talk about what drives a high valuation and what compromises that higher valuation.
Mm-hmm.
Yeah.
Yeah, so especially in the early stage, I say early stage, which
we're like Series 1, Series 2.
Yeah, I mean it's funny because I don't know that it has a definition, right? I mean, I think in a sense it's from a guy in a garage that has an idea to all the way up through, you know, M&A or exit or M&A or IPO, right?
No kidding.
Yeah, I mean,
it's that big of a range.
Yeah. So
this is not just a company that's been in business for 3 years and they've got revenues of X a year with a.
Yeah.
This is really.
Well, it's used.
So you're evaluating ideas also.
Yeah. 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 I mean, that early stage is. It's used. It's used. Yeah. It's used in a lot of different contexts. If you talk to a venture firm, they'll say we're early stage or late stage, which that's you know more Series A, Series B versus Series, you know, pre-IPO or growth stage or so.
Pre-IPO, there's a track record, but boy, that early stage, that's gotta be subjective.
It's always. I mean, it's always subjective, right? There's anytime you're doing evaluation on a private company, we tell people. You know, if anybody tells you they know exactly what the value of a private company is, they don't know what they're doing. That's the last person you want to talk to because it's a range, right? I mean, nobody can really say the exact value. We have to come to exact values for, you know, financial reporting and tax purposes and different reasons, but yeah, and so it is because there's just so many factors that.
So let's talk about those factors.
Yeah. It's interesting. So you're definitely seeing a shift right now. So I actually, I think you were there. I gave a talk a couple years ago, maybe. Here in town, and one of the things that I spoke about was what are investors? What's the you know, IPO market, the stock market? What are they paying for right now? And it was growth. And the example is Amazon versus Walmart, right? Or Tesla versus Ford. There's still some of that going on.
Tesla's crazy right now, right?
Yeah, Tesla. I guess
it's just amazing story.
Yeah, I guess so. Tesla right now is the value of Tesla is now worth more than Ford and GM together combined.
And what's fascinating in that specific, and you know, we're going to date ourselves because a month from now, when this is actually released, we don't know what's going to happen. But it's totally striking how much money is being invested on the bull side, of course, of Tesla's value, and there's a ton of money being invested on the bear side against this current growth spurt. So, anyways, it's super fascinating, I'm sure, for everybody.
Yeah. So it's a bit of an anomaly, but the point I made then was people are paying for growth.
I see.
You know, Amazon has had growth rate, you know, significantly above Walmart. Even though Walmart, if you look at the assets, is a huge, you know, much bigger company. They're not paying for buildings; they're paying for revenue
brick and mortar.
Right?
Yeah, sure.
And you know, that was definitely the case. You know, definitely 2 years ago, maybe even a year ago. We've seen a little bit of a shift lately, in that come from Uber and WeWork. to where revenue growth is still important, but a path to profitability is also very important.
The time frame.
Yeah, and just having a plan. This is how we get. We may not be profitable right now because we're expanding. We're trying to capture market share. We're innovating. We're changing the world. But having that plan of this is how we get from growing revenues and being unprofitable to this is how we generate a profit. And that wasn't the case, like I said, even a year ago. It was, hey, worry about profits later.
It's all focused on growth.
It's all focused on growth. And I think, that's one of the ways that we got a,
crazy evaluation.
Huge value. And then when they started to go public, started that process, people were saying, oh, hey, hold on, what's the eventual plan here? And they got crushed because there wasn't a great plan.
Right. Well, and they were leaning into one guy and one guy's vision and force. And I mean, I've worked with Adam, as a customer and a client of WeWork, and love what they were doing, love their culture, love their business model. World traveling that I do, I see them everywhere. So I believe in the brand. I believe in the model. And I also think, they were an anomaly in terms of being able to create as much inventory that they created. And I think they were definitely onto the nature of 21st century business,
the way people work,
and the way people work. I mean, that's a home run. They definitely nailed that. There's no doubt about it. But this is interesting that now there's been this shift in valuations from focusing a lot on growth without really now thinking about, so when are we actually going to make some money here? And, the notion is, of course, that a lot of certainly angel investors or even venture capitalists who are investing want to see that return in 7 or 8 years. So I imagine now that also is becoming more of a factor when valuating a company. Can they actually be into a state where they can return those investors money in 7 or 8 years? And if they're not, then maybe that higher valuation isn't as justified. Yeah.
I mean, a lot of investors, the way they will look at it, both angel and venture, they'll take as simple as kind of back of the envelope. With the venture example, we want 10 times our money back. We want to make 10 times our money, right? Rule of thumb. And so they'll literally say, okay, the value that I'm going to pay today, I determine that by, I think this is something that would be acquired or IPO in, say 5 years. And I think that this type of company at exit is worth X. Take X divided by 10, and that's what I'm willing to pay for it today. And so there's your 10 times return, right? And there's it can get a little bit more complex than that, but that's basically that's what I'm willing to pay for it. And so I guess part of that goes behind that is this a business that can get to that, if it's, $1 billion in value, can it grow at 10, can it be 10 times,
within that time period?
Which, which narrows your field quite a bit, right?
Right.
It takes out a lot of the and these are obviously, like I said, venture investors. So they're not investing in dry cleaners or more mom and pop businesses.
Not necessarily brick and mortar.
Yeah, not necessarily brick and mortar, which are great businesses and
sure.
But not VC type investments.
So when you said earlier that what drives valuation is in fact very subjective. will you find then, I mean, it stands to reason then that if you were to have one valuation company evaluate a business, you might get a different valuation with another valuation company?
Yeah. Yeah.
And
yeah.
how big of a gap?
Yeah, I mean, it can be significant.
It can be significant.
Yeah.
And what are the factors that drive that gap?
I mean, typically I shouldn't say it's more rare that it would be a significant difference than the norm, but it's definitely going to be different.
Okay.
But often not significantly because, when we do evaluation, we're, a lot of, you could even look at it as first pass is the numbers, right? What are the numbers telling us?
Their growth rate over time, numbers of
Yep.
customers,
Yep.
customer acquisition.
Yeah. Even as simple as what's, revenue, what's, what are the assets and liabilities on the balance sheet, right? Then, and that kind of gets us to a point, then we step back and say, okay, what else is going on?
Within the company or in the market?
Both,
Uh-huh.
yeah. Within the company, the management team, we'll see. I mean, we worked with a company that I think they raised over $20 million without a dime of revenue, pretty much based on, not a finished product. And you look at that and you say, and that's kind of one of those things that it's a data point. You say, okay, well, how did they do that? And then you start looking at the management team, and you realize that, okay, the CEO and founder has had 3-4 exits, all have made a lot of money for investors.
They're not going to waste their time.
Yeah, yeah. The CFO has had a couple exits, that made a lot of money for investors. And so, that company's, take that compared to a first-time founder that's heading down this route, and first-time founder might have a huge success, but there's more risk there, right? If you're an investor, you're going to probably pay more for the company that's led by people that have had a track record.
So people do make a big difference.
Yeah. Yep. Yeah. So yeah. I mean, we kind of look at all that stuff. If it's a hot market, in terms of like we work with a good amount of life sciences, biotech. The pain, it's a little bit. I mean, somewhat counterintuitive, but some pain solutions right now are out of favor. If a pharma company or life sciences company has been working on a pain solution, those companies are not getting as high valuations. They're not getting as much dollars in investment.
Because they're focused on pain relief?
Because they're focused on pain relief, and because of it's kind of a fallout of the whole opioid thing. Even if their solution has nothing to do with opioid, I think investors right now are saying, okay,
There's not as much money in pain relief?
Well, we're a little scared about this market right now because nobody saw the horrible things that ended up coming out of the opioid epidemic.
Right.
And
there's going to be fallout for that for years still.
And
it's basically tobacco playing itself out again.
Yeah. And that's, I mean, that's my view on it. Somebody, but we're seeing less money going to pain solutions and kind of lower valuations in pain solutions than other areas of life sciences and biotech.
Like cancer, solving cancer.
Yep. So yeah,
I see. So a little bit of then is also shaped by the marketplace and the need in the marketplace for that product or service.
Which is
okay. So your team is going to impact your valuation, their track record, perhaps the sector that people are in. I am hearing that you don't necessarily need a product.
Yeah,
granted, now we're overly weighted on who the people are that are driving it, but that product doesn't necessarily have to be generating sales.
Mm-hmm.
I would imagine, though, if you've got a product and you've been selling it and you've got a track record and you've got your P&Ls and your financials square, it's got to be worth something. Yes.
Mm-hmm. Yep.
Yeah.
Mm-hmm. And it's also regional. The same company in San Francisco is probably going to get a higher valuation than the company in Columbus, Ohio. There's some of that, and
is that because of the consumers in that market, or is it?
It's more driven, at least in the venture-backed world. It's more driven by investors. So you have more investors fighting over fewer opportunities.
So change your zip code and you'll get a higher valuation.
Yeah. I mean the joke that somebody I told that I essentially that we were talking about a company that was looking to raise $1 million, and they were not located in any of the big hubs, and it was we'll move to San Francisco. In San Francisco you can trip over $1 million walking down the sidewalk, whereas in other places it's hard to raise $1 million. So. There's some of that.
Go figure.
There's some of that in terms of the location. Hopefully that's not a huge factor, right? And it's that ebbs and flows as well. When investors in the big hubs find that that valuations are high and they don't want to pay up for deals, then they're influenced to look elsewhere, right? Then they're going to go looking for deals. They're willing to get on a plane to find good deals, as opposed to maybe overpaying for something that's right down the road in San Francisco or New York. Or
in terms of the process of evaluation, I would imagine, and please let me know if I'm delusional, but I can imagine that you can evaluate a company on a napkin at some point. And then, of course, there's, all right, now we're going to really follow it up with a 30-page report that's got all the hard numbers. But I imagine when you're at this over time, is that napkin valuation doable? Is that something, and how big of a gap often are you seeing? And I imagine that a lot of this is also your own experience over time with having a really, strong capacity to understand that 30,000-foot view of the marketplace and the founders and the potential, other investors that are going to be sort of attracted to that deal, which I can also imagine can impact the valuation of the company. But is there a big gap between that napkin and that 30-page valuation report?
It depends on who's writing the numbers on the napkin. It really does. We did a kind of a post-deal valuation for a company that was essentially bought out by 3M. And it was an individual, a guy that had this business for years and kind of stumbled across something and made a pretty good business out of it. Had some relationships that facilitated that. And he sold the business to, 3M came knocking and they put a number in front of him. He said, yes, that's more money than I ever thought I would ever have. And said, let's do it. And, like I said, we did the valuation post deal,
for 3M or for him?
For 3M.
For 3M.
And when essentially we're valuing the pieces of the pie, for financial reporting purposes. And we looked at it and we just, it was worth way more than what he got for it.
But he was happy.
Yeah, he was
3M
happy.
was happy,
Yeah,
but like,
yeah,
really?
Yeah. So it can depend.
And what were the factors that actually saw that valuation increase?
Without going into the details
in that post, without getting into the specifics, what were some of the factors?
It was the market. I mean, he was serving a very specific market, which was a good market, but the potential market was huge. And he, there were two things. I don't think he saw what that potential market was. Would probably, he'd have to be a much bigger organization to
have you been aware of those other markets
to go after that market, right?
I see.
And he may have been aware of that market and just didn't want to, wanted to retire and wanted to hang it up, and I don't want to be the CEO of a huge company,
a multinational, essentially.
And 3M could tap into that market pretty easily.
I see,
because of their size and their resources. And so there was that, and then there was just simply he in his wildest dreams he never thought he would.
So he was happy.
Be handed a check, of where he was. So so it's
well, it sounds like a win-win.
Yeah. It was a win-win, but from a valuation nerd standpoint and a finance and numbers geek.
To see that gap.
We looked at it and thought,
boy, he could have got more.
Yeah.
He should have come to us.
Yeah, exactly.
Right.
Yeah.
Well, 3M felt great about it.
Yeah. Yeah. And I'm positive they've made a lot of money.
That's great. So some success stories. What about some horror stories? Anything in terms of, because that would sort of translate into a complete over-evaluation.
Mm-hmm.
And I'm very keen on understanding, particularly for our listeners, what are the things that do get typically over-evaluated? Is it the team? Is it the market? Is it the product?
It's,
I'm sure it varies, but typically where do valuations, when they do get over-evaluated, where do they fail?
It's it's usually the just the unknowns, right? It's the same thing, that the same factors as to why businesses fail, right? So it's a it's an amazing idea that looks incredible on paper, but one tiny factor was just missed, amazing idea, but turns out consumers just aren't going to make that leap, and so and it's the companies we work with, the venture-backed companies, it's probably on the low side, 75% failure rate.
On the low side.
Yeah.
That sounds like a big number.
Yeah. And
that's the low side.
Yeah. So different organizations have done studies, and have, essentially have come to, of venture-backed companies. So not even, early stage where you're financing it yourself out of your own pocket. You've gotten to the point where somebody's willing to give you money for it, or give you some investment. Of those companies, 75% fail, and that's that's, like I said, it could be higher than that, probably 75 to 85. And so the value at any given point is one thing. The value 2 years later, obviously can be very different, right? That's
a whole bunch of data there. Yeah. 2 years of it. Sure.
Yeah. So the thing that kind of, the thing that we see in terms of when something gets overvalued is it's the same factors that affect whether a company succeeds or not, right? Whether they make it or not. You will see situations where you'll get kind of an investor feeder frenzy. Investor frenzy where
people think, okay, they're in early. How come they're in early?
Yeah. Or what gets really interesting is when you have you'll have a company that or a venture firm that invests in a company, and ABC company, and that company XY has a competitor, XYZ company, that very similar, very different stage, and it looks like a good opportunity. That the market, the industry, and everything looks like a good opportunity. You'll see other venture firms come in and say, well, we can't get a piece of the pie of ABC because it's already, they've already taken their investment, but XYZ is over here. We can get a piece of that. And
because they're in love with the sector.
Yeah. And then you'll have several VCs, fighting over that deal. And then you can get, each VC's wants their horse to win, right?
Sure.
So they'll start pumping money into it. And at valuations oftentimes that, either don't make any sense at all or at best are on the high side.
So it would be probably in ABC's best interest to go get another valuation, because I would imagine that would be quite a bit higher based on what's happening over here at X, Y, and Z.
Yeah.
Right?
Yeah. Yeah. So yeah.
So for the startups and entrepreneurs out there who have been in business, let's say we're not just that one person in a garage, and it's more than just an idea. They've got a team. What are some of the things that a business owner should be thinking about when they realize, all right, at some point, I'm going to need some capital. I'm going to need to bring in investors, and I'm going to need to bring in investors at a level that are going to they're going to want a valuation. What are the things that business owner can start to do to enhance their valuation in terms of best practices?
Yeah. So there's a lot of
factors. What would you advise?
Yeah, it's I try to tell people, think in terms of risk mitigation from the standpoint of, because an investor is coming in and any private company really, there's significant risk there, and a lot of unknowns, and especially a high growth, innovative idea. It's one of the riskiest investment categories there is, right? So anything the investor, anything you can do to show the investor that there's less risk, from the standpoint of revenue growth, right? Okay, are people going to pay for this? Do people like this idea? Are people going to pay for it? Well, we started selling our solution, 2-3 years ago, or a year ago, and the revenue's gone through the roof, right, since.
Doesn't look risky now.
Yeah. Yep. Back to the team, right? If you can say, this team has done this 3-4 times and we've been successful, had success in the past, we think we're going to be successful here as well. This is why it lowers the risk for the investor, right? They're thinking, okay, I don't have to worry about, there's less risk here, right? In terms of the team and what's going to get this to a big valuation. So you can think about it from the standpoint of what can I do, or what can I show the investor that's going to give him or her less heartburn, what's going to cause less concern, and what's going to mitigate risk.
It seems a little counterintuitive, because I know that as a startup entrepreneur, business owner, I'm already in a risky place because I'm doing this all out of my back pocket, but I am really keenly focused on making sure my product or service is watertight and that I can deliver a consistent experience for my consumers. And I'm sticking my neck out and throwing a ton at user acquisitions or client consumers, there's probably in that early stage a lot of promises made about what can be done, because you do want to show these growth tendencies to be able to then show your future evaluators that I got traction, people love my product and service. But that's only sustainable for so long. And I would imagine with any kind of valuation, they are looking at that 7 to 8 year trajectory. And I have to believe that when looking at some hiring specifics that will kind of be a strategic decision to ensure that pace can continue. So this might mean investing in sales versus marketing over time and finding the right people in that fit. That seems like a smart thing to do if you're looking in the spirit of that valuation to say, hey, I'm committed and I've made decisions to commit to this 7 to 8 year trajectory, as opposed to throwing a ton of money at marketing and showing off what I have, but not really seeing ultimately sales from that effort. And I guess in the early stage of any company, it's hard to balance those decisions. And now I haven't even said anything about how much should I be investing in the product or the service or refining. Like, I got my 1.0 out. It's an MVP. It kind of works. And of course, I'd love to add some whistles and some shine and some polish to this. But, it works and people are willing to accept that. I guess in terms of prioritizing for a higher valuation, where do you encourage people to focus?
I mean, it's hard to argue with revenue, right? With results. That's if you can say people are paying for it, and if it's a reoccurring revenue model where it's a monthly subscription or annual subscription,
even better.
If you can say that's a good model to be in, and the renewal rate is high, 85, 90%. So people not only like it, but they like it enough to keep using it, right? To come back. It's not they buy a member or a subscription once and end up not using it and drops.
Churn rate's really high.
Yeah. And so that's really that's you can hang your hat on just financial results.
So that still holds true.
Yeah. Users is another one that is a little bit, more gray.
Really?
Yeah. I mean, so the ultimate example there is WhatsApp. WhatsApp, when they were bought by Facebook, had 450 million users. Their revenue was marginal. I mean, they weren't really generating much in terms of financial return at all. It was very little, but Facebook came in and ultimately said, we're willing to pay $19 billion for this company because they had 450 million users. And
it's a lot of people we can be in relationship with.
Trying to put a multiple of $19 billion on whatever,
per user.
Or per revenue, right?
Right.
That's some crazy multiple that doesn't make any sense. But it's, they were willing to pay that. So, in certain markets, users are a catalyst.
That's helpful.
Yeah. I've read and heard that Facebook still has not gotten their return on that, and that was years ago. They probably overpaid for that, but yeah, it's and it's very industry to industry, right?
So the industry is going to be impacting that as well.
Yeah.
So in wrapping this up, what are things that a startup and an entrepreneur should avoid as they're approaching evaluation, and what are things they should turn the volume up on?
Yeah, if you can point to results, that's the you point to resorts that's is going to resonate with investors or anybody that's looking at the company. The one thing, or not the one thing, but something that you do see quite often, or maybe more than you should, is founders that say, well, I want to get a really high valuation. I want the highest valuation possible. So I'm going to come in and say my company's worth $100 million, or whatever it might be. And oftentimes they walk into the room to talk to investors with this idea in their head, and maybe not a whole lot of justification behind it. And then, they say it's worth $100 million, and the investor says, I'm thinking more like 5. And they both walk out disappointed. And so, being realistic and having an understanding of the value is really important. The other side is the founder wants, when they get investment from whoever it is, they want that to be at a fair value. They don't necessarily want the highest value they can possibly get, because what happens is, say you raise money, you really pitch well, you make big promises, and you raise a Series A, and that Series A is at $1, right? $1 a share. Well, if you then either perform as expected or underperform, and you inevitably have to go out and raise your Series B round, if you have to raise what's called a down round, a round that's
where you're valuated less than the first go round.
Yeah. So your Series B is at 75 cents. What'll end up happening is essentially, the investors will come in and say, okay, Series B looks like it's going to be a down round. I'll pass. Thanks, but no thanks, because it signals things are not going well, and it's a signal to the market that that investors are not willing to, they'll see that and say, yep, sorry, I'm gone. So if your Series A is way overvalued, you can shoot yourself in the foot, because then you won't be able to raise a Series B,
right?
And you're dead in the water. I mean, most at least venture-backed companies are going to have to raise 3-4 rounds of financing. So if you try to get too high of a value, or if you're overvalued at any one of those stages, it can kill your next round.
Super important.
So yeah.
Good, helpful. So if somebody wanted to reach out to you or to the fund to find out more about the pathway to valuation, how could they do that?
Email is great.
Okay.
It's just tim@redwoodvaluation.com.
Excellent.
Or check out the website,
okay.
redwoodvaluation.com.
Perfect. And during a valuation, I know we can do one on a napkin and we can do one with that report. What kind of time is involved in a valuation normally?
Yeah, it depends a little bit, but usually, so once we get engaged, we send out an information request list, which
well, like a tax return form, or not a return form, but actually tell us what happened this year fiscally.
Yep. Cap table, financials, things that you would think of. So from the time we get all the information back that we need, it's depending on the engagement, 2 to 4 weeks.
Oh, okay.
So we try to turn around pretty quickly. And then what we typically do is, once we deliver that as in draft form, we will jump on a call or even just communicate through email, whatever the client's most comfortable with, and answer any questions, because we realize that this valuation world is not everybody operates in the valuation world, right? And so the client we'll look at this report and
There's a bit of an education involved.
Yeah. I mean, we try to make it as straightforward. This is the number you care about, and it's right up front. But
this is also how we got there.
So we want to make sure that the client's comfortable with what they're looking at, and the numbers that have been put in front of them.
Great. Tim, thanks so much.
Yeah.
Appreciate you coming on to the WatchPitch Podcast.
Yeah. Thank you.
All right. Cheers.
Cheers.
All right.